Imagine you're at a birthday party. Someone hands you a slice of cake. Then another. Then another. Nobody's keeping count. Nobody's stopping you. And for a while, it feels amazing. That's what America felt like in the late 1990s and early 2000s. Interest rates were low, the economy was humming, and the idea, drilled into every American from childhood, was simple.
Own a home, build wealth, live the dream.
Banks were on board, the government was on board, even your neighbor with the spotty credit history was on board, because suddenly, he got approved too. Home prices climbed, then climbed faster, then climbed so fast, people stopped asking why, and started asking how much can I borrow? Here's the thing about a housing market that only ever goes up. It makes everyone feel like a genius. Flippers bought houses and sold them 3 months later for a profit. Homeowners refinanced to pull out cash, for vacations, cars, renovations. Lenders approved more loans, builders built more houses, and at the center of all this? Mortgage. A mortgage is just a loan to buy a house. You put some money down, the bank covers the rest, and you pay it back, with interest, over 15 or 30 years. Simple enough, but something changed. Banks started handing out mortgages to people who, frankly, couldn't afford them. We're talking, no income verification, no down payment, adjustable rates that look cheap now, but would balloon later. These were called
Subprime mortgages.
Named for the borrowers, people below the prime, or ideal, creditworthiness threshold. But nobody called them high-risk loans. They called them
opportunity.
And here's where the story gets interesting, because the problem wasn't just reckless borrowers. The real fuel came from Wall Street. Let's talk about Wall Street's greatest magic trick. Picture a bank. It gives out 100 mortgages. Now it has to wait 30 years to get its money back, right? Not anymore. Banks discovered they could bundle those mortgages together, hundreds of them, and sell that bundle to investors as a product. A bond-like security that paid out as homeowners made their monthly payments. This was called a mortgage-backed security, or MBS. On the surface, not a bad idea. Spread the risk, get capital back faster, lend more. But here's where it unraveled. When a bank sells your mortgage, it doesn't care anymore whether you can pay it back. That's someone else's problem now. So why bother checking if you can afford it? Lenders approved loans. Banks bundled them. Wall Street packaged and sold them. Investors around the world bought them. Pension funds, foreign banks, insurance companies, chasing that sweet, sweet yield. And rating agencies, the firms paid to assess how risky these products were, stamped many of them AAA. The safest possible rating, AAA, safer than most government bonds, they said. They were not. Wall Street then took it further. They took bundles of mortgage securities, and bundled those together into even more complex products called CDOs, collateralized debt obligations. Layers upon layers, risk buried so deep inside the math, almost nobody understood what they owned. One investor later described it like this. You could slice a bad hot dog, regrind it, repackage it, and sell it as filet mignon, and the label would say, premium. And banks weren't just selling this stuff. They were buying it, with borrowed money, leveraged to the hilt. Some investment banks were borrowing $30 for every $1 they actually owned. That's called being leveraged 30 to 1, which means, if the assets you hold drop even 3% in value, you're wiped out. By 2006, a few sharp-eyed analysts started noticing cracks. Default rates on subprime loans were creeping up. Home prices in some markets started plateauing. New buyers were drying up. The housing market needed a constant stream of new buyers to keep prices rising. When that stream slowed, the math stopped working. Think of it like a game of musical chairs. While the music plays, everyone dances. Everyone's fine. Nobody wants to be the one to sit down first. Then someone cuts the music. In 2007, adjustable rate mortgages began resetting. Monthly payments jumped, sometimes doubled. Borrowers who were already stretched thin couldn't keep up. Defaults surged. The mortgage-backed securities those loans were stuffed into, suddenly worth far less than anyone thought. And the CDOs built on top of them, potentially worthless. But here's the cruel twist. Nobody knew exactly how much exposure anyone had. The products were so complex, so opaque, that banks looked at each other and thought,
I don't know what's on your books. And you don't know what's on mine.
So they stopped lending to each other. Credit, the lifeblood of the financial system, froze. On September 15, 2008, Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. $600 billion in assets. Gone overnight, it was the largest bankruptcy filing in American history. The shock hit global markets like a defibrillator on a stopped heart, except it didn't restart anything. It sent everything into arrest. The Dow Jones fell nearly 778 points in a single day, the largest single-day point drop in history at that time. Banks stopped lending to businesses. Businesses stopped hiring, then started firing. 401ks, retirement accounts holding the life savings of ordinary Americans, lost trillions in weeks. By the time the dust settled, $19 trillion in household wealth had been erased. More than 8 million Americans lost their jobs. Millions lost their homes. And the crisis didn't stay in America. It traveled across every financial system on Earth that had bought into the mortgage security machine. Iceland, Ireland, Germany, Greece, a homegrown American disaster became a global catastrophe. The US government faced a choice most people never want to face. Let it all burn, and risk a second Great Depression. Or, save the institutions that caused the fire. In October 2008, Congress passed the Troubled Asset Relief Program, TARP. $700 billion authorized by the US Treasury to stabilize banks by buying up toxic assets and injecting capital directly into financial institutions. Citigroup, Bank of America, AIG, the insurance giant that had sold hundreds of billions in insurance-like contracts on these securities without nearly enough reserves to cover them. The government also effectively took over mortgage giants Fannie Mae and Freddie Mac, placing them into conservatorship. The Federal Reserve, America's central bank, slashed interest rates to near zero and launched emergency lending programs to keep credit flowing. The goal: stop the bleeding, buy time, prevent collapse. Here's a nuance most people miss. Much of TARP was eventually repaid, with interest. The government actually turned a profit on several of the bank bailouts. But that framing did very little for the family who lost their home. Because here was the enraging reality. The banks, whose recklessness lit the fuse, got rescued. The executives who ran those banks kept massive compensation packages. And millions of ordinary Americans, who had played by the rules, or were sold products they didn't fully understand, got foreclosure notices. No bailout for them. That asymmetry, that fury, never fully went away. It seeded a decade of political anger that reshaped elections, spawned movements on both the left and right, and fundamentally altered how Americans think about banks, government, and who the system actually works for. But that framing did very little for the family who lost their home. The formal recession ended in June 2009, but recovery was slow, uneven. Millions of workers never came back to the labor force. The regulations that followed, most notably the Dodd-Frank Act of 2010, imposed new rules on banks, higher capital requirements, stress tests, consumer protections, and new oversight of complex financial products. Did it fix everything? No. Did it make the system more resilient? Most economists say yes. So what do you actually take away from all this? 1. When an asset, any asset, seems to only go up, that's not a law of physics. That's a story people are telling each other. Stories end. 2. Complexity is often used to obscure risk, not eliminate it. If a financial product is too complicated to explain in plain language, that's a feature for the seller, not the buyer. 3. Leverage amplifies everything. Gains on the way up, losses on the way down. The same mechanism that made banks look like geniuses in 2005 made them insolvent in 2008. 4. The people who design the game are rarely the ones who pay when it breaks. Understanding that isn't cynicism, it's literacy. 5. Diversification, emergency funds, and not borrowing more than you can realistically repay aren't boring financial advice. They're the lessons written in $19 trillion of erased wealth. The 2008 financial crisis didn't happen because of one greedy person or one bad decision. It happened because an entire system, lenders, banks, rating agencies, regulators, and yes, some borrowers, all found reasons to look away from obvious risks, because looking away was profitable. Until it wasn't. Understanding how it happened is your first line of defense against the next version of it. And there will be a next version. Different clothes, same skeleton. Thank you for watching. Subscribe.